Imagine putting all your money into one stock, and the next day, boom, that company crashes. Now your life savings? Gone. No backup, no protection, just a costly mistake. Now imagine a different story. You invest in many areas: stocks, real estate, crypto, bonds. One goes down, another goes up. Your money keeps growing. That's the power of diversification. In this video, you'll learn what diversification really means, how to do it like the pros, and how it protects your money, even in wild markets. Let's get started. Section 1. What is diversification? Diversification means not putting all your financial eggs in one basket. It's a strategy where you spread your investments across different assets, industries, and even countries to reduce risk. Why? Because no one, not even Warren Buffett, can predict exactly which investment will win every time. Sometimes tech stocks boom, other times real estate shines, and occasionally even gold outperforms everything else. Diversification is your safety net. It helps you grow steadily, without one bad bet wiping you out. Section 2. Why diversification is so important. Let's look at some real-life scenarios. In 2008, the housing market crashed. People who only owned real estate lost big. In 2001, the dot-com bubble burst. Investors with only tech stocks crushed. In 2022, crypto dropped over 60%. Anyone all in? Ouch! But investors who were diversified, they took hits in one area, but had gains or stability in others. Diversification doesn't guarantee profits, but it does help you avoid catastrophic losses. It smooths out your returns and helps you stay in the game long enough to win. Because here's a secret: the biggest key to wealth: staying invested. And you can't do that if panic wipes you out. Section 3. The core types of diversification. There are 5 core ways to diversify your portfolio. Let's break them down. 1. Asset class diversification. This means spreading your money across different types of investments. Like stocks, great for growth. Bonds, more stable, less risky. Real estate, physical asset, rental income, cash or cash. Equivalents, safe, liquid, commodities, like gold or oil. Cryptocurrency, high risk, high reward. 2. Industry diversification. Even inside stocks, you don't want just one sector. Tech, healthcare, energy, finance, consumer goods. Each performs differently depending on the economy. For example, if you only own tech stocks, one crash in that sector can hit your whole portfolio. But if you have some healthcare and energy too, you're balanced. 3. Geographic diversification. Don't only invest in one country. Add global exposure: Europe, Asia, emerging markets. Why? If one country's economy crashes, others might still thrive. 4. Investment style diversification. Mix growth stocks, fast-growing but volatile, and value stocks, stable, often pay dividends. Combine small-cap, mid-cap, and large-cap stocks. Different styles perform well in different market cycles. 5. Time diversification, also called dollar-cost averaging. Instead of investing all at once, you invest smaller amounts regularly. This smooths out market highs and lows over time. Section 4. What happens if you don't diversify? Let's say you go all in on a single investment. Maybe it's Apple stock, or Bitcoin, or one hot real estate deal. If it does well, you look like a genius. But if it crashes, there's nothing else in your portfolio to cushion the fall. This is called concentration risk, and it's the #1 way investors lose money fast. Diversification lowers this risk dramatically. Instead of betting on one winner, you create a team of assets that work together, some aggressive, some stable, to move you forward. Section 5. How to start diversifying, step by step. Ready to build a smart, diversified portfolio? Here's a simple 5-step plan to get started. Step 1. Know your risk tolerance. Are you conservative, moderate, or aggressive? This decides how much of your portfolio goes into stocks, bonds, or safer assets. Step 2. Pick your core assets. For most people, start with index funds or ETFs. Already diversified, a mix of US and international exposure. Add real estate via REITs. Hold some cash for flexibility. Step 3. Add variety within asset classes. Own stocks in multiple sectors. If you're into crypto, don't just hold Bitcoin. Add Ethereum or stablecoins. For bonds, choose both government and corporate options. Step 4. Rebalance regularly. Check your portfolio every 3 to 6 months. If one area grows too large, shift some money to stay balanced. Step 5. Don't overdo it. Yes, you can over-diversify. Too many small investments can dilute your returns. Aim for 10 to 15 strong, varied holdings, not 100 tiny ones. Section 6. Diversification myths. Let's bust a few common myths. Myth number 1. Diversification kills returns. Truth. Poor diversification does. Smart diversification boosts returns by reducing panic and loss. Myth number 2. Buying 5 tech stocks, it's diversified wrong. That's sector concentration, not real diversification. Myth number 3. I don't need diversification. I've done my research. Even the best research can't predict global events, pandemics, or political shifts. Diversification protects against the unknown. Section 7. Real-life portfolio examples. Here are 3 sample portfolios. Conservative portfolio 40%, bonds 80%, stocks 20%, real estate 10%, cash great for low-risk investors or retirees, moderate portfolio 60%, stocks 25%, bonds 10%, real estate 5%, crypto. Good for balanced growth with some safety. Aggressive portfolio 80%, stocks 10%, real estate 10%, crypto alternatives. Perfect for younger investors with long-time horizons. 3 pie charts side by side with clear labels. Section 8. Final tips to remember. Tip 1. Diversify by design, not by accident. Plan it out, don't just collect random assets. Tip 2. Use ETFs or mutual funds to diversify instantly. They give you built-in diversification across hundreds of companies. Tip 3. Be patient. Diversification shines over years, not days. Tip 4. Stay consistent. Don't try to time the market, just keep building. Tip 5. When one part of your portfolio is down, remember, that's exactly why you diversified in the first place. Building wealth isn't about luck. It's not about finding the next Tesla or catching the next crypto wave. It's about strategy. It's about managing risk. And it's about building a portfolio that can survive anything and grow over time. That's what diversification does. So take the time, spread your investments, and watch your money grow with way less stress. If this helped you, give it a like. Comment below. What's one asset you've added recently to diversify? Subscribe for more smart money videos every week and turn on that bell so you never miss a new one. Thanks for watching. And remember, it's not about timing the market. It's about time in the market with a smart, diversified plan.